UGC Net online. Welcome to the UGC Net online classes conducted by Commerce Club, Department of Commerce, University of Kerala. Today's class is gonna conduct by Dr. Biju A V sir on the topic Business Finance. Dr. Biju A V is the Assistant Professor of Commerce at the Department of Commerce, School of Business Management and Legal Studies, University of Kerala. He is acting as a research supervisor under the Faculty of Commerce in University of Kerala. He produced 3 PhDs under the Faculty of Commerce and supervising 4 PhD scholars. He is an active researcher in the areas of finance, especially behavioral finance, stock market, and organization behavior. He is also actively involved in teaching, research, consultancy, and training for some of the public and private entities in national and international level. He is an active member of the research forum Research Science Frontier UAE. He is acting as the editorial board member of InterScience and IGI Global Journals. He is acting as a mentor of startups and fellowships in other universities. I invite Dr. Biju A V sir for taking today's session. Welcome you, sir. Please.
Okay, thank you for the introduction. Shall I start? Am I audible right now?
Yes, sir. Audible. You're audible.
Okay. So I hope Tuesday will be the examination, right? So when will be the examination?
Sir, it's on Tuesday.
Okay. So I will take you to the lessons. I will take around 30 to 40 minutes, and I will after that you can ask questions from the topic. So the area is business finance, and the scope of finance. The finance can be divided broadly into 3 distinct categories: public finance, corporate finance, and personal finance. And there is a recent categorization of finance, that is social finance and behavioral finance. So here 5 categorizations: public finance, corporate finance, and personal finance. Now social finance and behavioral finance. Public finance means is public economics, public expenditure, etc. Corporate finance consists of the financial management area, financial market and services, capital structure. As per your syllabus, major part of the syllabus which constituted from corporate finance. And personal finance, which combines like retirement planning, estate planning, in-service savings plan, etc. So purely personal. And there is a new categorization, that is social finance. Social finance means like financial inclusion, exclusion, financial deepening, that area. Social finance or finance to the social services, social entrepreneurship, like impact financing, etc. And behavioral finance, of course, is another categorization. It covers areas, when the old traditional modern, standard finance is weak. That areas we use behavioral finance. Okay, so behavioral finance, which covers areas like behavioral biases affecting financial decisions, rationality, bounded rationality, etc. So these are the areas of finance. I repeat once again: finance, which consists of public finance, corporate finance, personal finance, social finance, and behavioral finance. Okay. So then finance functions. My slide is visible, right?
Yes, sir.
Yes, sir.
Visible.
Okay. So finance functions consist of investment decisions, dividend decisions, and financing decisions. So these are the three finance functions. So out of it, investment decisions means where to invest, what to invest. So we should take the return on investment, the cost of capital. So different concept which comes under investment decisions. There are different alternatives to invest. When we take an individual case, also we have different options. So we have to take a best decisions, best investment decisions. So similarly, companies also do take actions uh, for opting the best investment decisions. And dividend decisions is very significant for a going concern, a company. Uh, like dividend decisions means what amount of money can be distributed as dividend. The company should take decisions on their payout. Payout means what amount of profit can be distributed to its shareholders as dividend. That is the payout. So the payout ratio may be 100 percentage, sometimes 50 percentage, sometimes 0 percentage. So that is up to you to decide, about the dividend decisions. So of course there are theories which model dividend decisions. Some theory says that dividend decisions are significant for the value of the firm. Some theory stated that dividend decisions are insignificant to determine the value of the firm. The overall concern of a company, all these three decisions they are taking, they should take care of the value of the company. So, what is the value? Value means the wealth maximization, the value maximization. So all the companies should take care of the value maximization. So when the company take investment decision, their aim is the value maximization. Dividend decisions, the aim is value maximization. And the next decision, that is financing decision, is another prominent decision. Finance decision means from where the company can source funds. So there are many sources of funds like equity. Company can collect funds through issue of equity shares. Company can collect funds through issue of debentures or bonds. So company can collect funds from ADR, GDR, other bonds, etc. So its cost is also different. The cost of capital is different. Equity capital is costly than the debt capital. So which consists of the determination of the capital structure. Again, there is theories, relevance and irrelevant theories. The decision on financing is, will influence the value of the firm. Decisions on the finance, in the sense that decisions on determination of the capital structure. So this decisions on determination of the capital structure will influence the value of the firm or not influence the value of the firm. So some theory states that it is influence the value of the firm. Some theory stated that it is not influence the value of the firm. So all the decisions, there are two approaches: will influence the value, will not influence the value. So both for and against theories are there. So we have to understand the both theories. Any questions in between? Just ask me. Right. So far, any questions? Then the source of finance. Source of finance. We have equity, preference, bonds, warrants, ADR, GDR, and foreign currency convertible bonds. So these are the source of finance. You can, I think, we can cover these lessons. And uh, of course, there is a bonus shares. Bonus shares means what? Bonus shares. When do a company issue bonus shares? So a decent profit making company can issue bonus shares because continuously the company is getting profits, and they don't want to distribute the profit in the form of cash. So they are issuing shares instead of cash, and that is free of cost. And a proportion can be decided by the company based on the existing shares held by the shareholders. So that is a bonus shares. And some companies, issue warrants, share warrants, stock warrants. So these are the options issued by a company that trades on an exchange or give investors the right, but not the obligation to purchase company stock at a specific price within a specific time period. So these warrants are the options issued by the company to the instrument holders. So they are getting some right. So warrant is a right, but it is an optional one. They can take or they cannot take. They can take or they sometimes they can avoid to take. Uh, so warrants, there are different types of warrants. Warrants is an option to the instrument holder. So some bonds, bonds have a warrant. These bond holders, after a particular period of time, they can convert the bonds into shares. Sometimes debentures with warrants, so they can convert the debentures to shares. So shares with the warrant, so they can convert the shares into bonds after specific period of time. So the warrants are options issued by the company to the holders, right? So different types of warrants. Call warrant. See, call warrant is a right to buy a specified amount of shares from a company at a certain price in the future. So call warrant is the right to buy a specified amount of shares from a company at a certain price in the future. So if an instrument issued by the company with a call warrant, the instrument holder has the right to buy specified amount of shares from a company at a certain price. And this price is also, uh, that is also the price is also stated in the warrant. So they can purchase the shares at a price given in the warrant. Put warrant is a right to sell back the specified number of shares to the issuing company. If at the time of purchasing shares there is a put warrant, so we can sell back. There is normally that is the this option is not available to the equity shareholders. So now with the put warrant, the holders has the right to sell back a specified number of shares to the issuing company at a specific price in the future, right? That is put warrant. So warrant certificate is issued when an investor is granted warrant. The certificate includes the terms of warrant, such expiry date and final date can be exercised, etc. So the warrant consists of warrant certificate. Uh, the warrant certificate shows the expiry date of the warrant and the final day in which it can be exercised. So this is warrant, and I said the call warrant, put warrant, and I said. So any questions? I think people can ask questions. So otherwise, it is like a one-way talking. It is not fair. I don't know you are understanding or not. Otherwise, I will ask questions to you. Okay. So it should not be like a person says something and you are keeping mum always. Are you getting my points? Are you
Yes,
getting
sir.
my point?
Yes, sir. Yes,
If
sir.
then after my presentation, the 10 to 15 minutes, I will ask questions to you, right? So please be prepared. I think nobody will be there after my presentations. People will, right, leave. So, warrant, I explained warrant, call warrant, put warrant is very important, warrant certificate, etc. And I explained bonus shares, the situations in which the company issuing bonus shares, and what happened when soon after the company issuing bonus shares in the market. Suppose one company issues bonus shares, and the market price which is there during that issue, uh, for example, 100 rupees 100, and the company issues bonus shares like 1:1 for one person holding one share, and he gets one share as free of cost. Suppose a person, holding 100 shares, and he gets 100 shares as bonus. That means altogether, uh, he is now having 200 shares. So the price, the time of bonus is 100, and 100 shares into 100, that is 10,000. And after bonus shares, 100 shares also, added to him, to the demat account. Now 200 shares. So what is the total net worth of him? So 100 multiplied by 100, that is 10,000 is the whole position. Now 200 shares, 200 multiplied by 100, that is 20,000, right?
Yes.
20,000, right? Hasina Fayaz says that it is 20,000, right? So I will repeat once again. I will repeat once again. 100 multiplied by 100. So one share rupees 100. The day bonus shares are issued by the company, that is 1:1. That means one share is free. So 100 shares are free. So the total shares now 200. I'm asking you, what is the net worth? Net worth of his position. Like, net worth means the total value of the shares. So earlier it was 10,000. What is the current position?
It's 20,000.
It is
200 into
200 into 100. It's 20,000. Subin has also said 20,000. So how it is possible? How it is possible? Will it reach 20,000 or 10,000? The number of shares, of course, the number of shares are increased,
No,
right?
it's 10,000 because we are
10,000.
issuing bonus share.
Because it
So
is bonus shares,
yeah,
right?
it's
Now
10,000.
10,000. That means the price which soon after the issue of shares, the price has come down to 50, because the same company, divide the shares into two. The same shares divided into two. That means the price remains the same. The value remains the same. So the value will be, come down to 50. So 200 multiplied by 50, that is 10,000. But the total number of shares he holding is increased. Okay, that is the peculiar nature of bonus issue. Okay. So this type of questions may be asked. So now there's non-voting shares. So what about your perception? All the shareholders are getting voting power, right? Which type of shareholders are getting voting right?
Equity shareholder.
Equity shareholders.
Equity shareholders, right? Only equity shareholders. Only equity shareholders. What about preference shareholders? What about preference shareholders? Asina Fayas, where are you from?
Edavanakad.
Huh?
Edavanakad, Ernakulam.
Ernakulam. So, where did you finish your masters, or you are studying masters?
SNM Malengara.
Okay, okay. Now you are undergoing masters MCOM program, isn't it? Or you
No.
completed?
Completed.
Oh, good. Okay. So only equity shareholders are getting the voting right. All other shareholders like preference shareholders are not having voting right. So for sacrificing the voting right, the company, issuing another different type of shares, that is non-voting shares. The non-voting stock has the other right that compensate for the lack of voting powers. So the preference shareholders are not having the right to vote in the meeting, and so that we are giving some kind of uh, preferences. What about the preference of preference shareholders? What about the
Dividend.
preference to get dividend? Then one more preference.
Preference to get payouts at the time of like last liquidation.
Preference to Shruti. How are you?
Fine, sir.
Okay. So preference to get the dividend as well as preference to get the repayment of capital at the time of winding up of the company, right? So these are the two preferences, but they don't have voting right. So to compensate the voting right, we are giving these preferences. And we have different types of bonds: central government bonds, state government bonds, municipal and local authority bonds, corporate bonds, public sector bonds, and tax-free bonds. So just you look over all these different types of bonds. And we have primary bond market and secondary bond market. Okay. So primary bond market means like IPO in shares. The companies are issuing bonds first handed to the bond holders, and secondary market, like stock market in which we can buy and sell bonds. So these are different type of bonds in detail: corporate bonds, convertible bonds, non-convertible bonds, government bonds. Okay, right? So would you prefer corporate bonds or government bonds?
Government bonds.
Why?
More security.
More security. Security aspect, as Shruti is right, the government bonds are fully secured by the government machinery. So the liquidity aspect, government bonds are good, like treasurables. So the government, and there are some tax exemptions also, so that people prefer government bonds rather than the corporate bonds. But the corporate bond is also, credit rating is available. So when they issue bonds, we can look over the credit rating, and if the credit rating is fine for the company, like if the company is having good credit rating, we can prefer corporate bonds. So moreover, the corporate bonds offering, just interest rate is which quite high as compared to government bonds, right? And this another one, that is sweat equity shares. So what is sweat equity shares? Anybody can say sweat equity shares?
Issued to employees.
It is issued to employee. Why it is named as set? What is the Malayalam word of set equity shares?
Viyarppu.
We are Pohadigal. Yes. Good. That means the people who are working in the company is eligible to receive said equity shares. So they are, they are giving some technical know-how their own way, so that the company, giving these shares as incentives, right? Sometimes it is offering free of cost. Sometimes, the company charge 50% or 40%, whatever it is. It's up to the discretion of the company from the employees to offer sweat equity shares. So we can have examples. For example, Infosys allocated 50 million shares to incentivize employees in a regulatory filing. In 2019, Infosys termed as its program 2019 plan as being distinct from the previous plans of 2015, where the granted shares were largely vested based on time. So different set equity options are available. So Infosys is the major company in India offering set equity shares. Then we have venture capital. What is venture capital? It's a form of private equity and type of financing that investors provide to startup companies and small business that are believed to have long-term growth potential, right? So the companies essentially request to start the business, but they don't have money. They can approach venture capital firms. They will provide the finance. But after completion of checking their feasibility of the proposal, so different stages of interviews are to be conducted, and after that interview, if the startup, clear the interview based on the feasibility of the proposal, they are eligible to get the funding from venture capital companies. Uh, another concept which is closely related to venture capital, that is crowdfunding. So, what is crowdfunding? Somebody asked, what will be your answer? Somewhat similar to venture capital. Yes. Crowdfunding. Yeah. Yes. Tell. Right or wrong, this is not my.
So raising money from a large number of people.
Raising money from large number of people. Yes, correct. So crowdfunding is a platform. So this platform aimed at collecting funds from the large number of people. So they have some website or app like platforms, and anybody wanted to invest in crowd funds, so they can invest. And these crowd funds, fund the value, startup companies. And based on the profit generated for that investment, it can be shared to the funders later. So crowdfunding, particularly startup companies, this is a major platform right now. So crowdfunding and venture capital already explained. So this is the very important question. I think I have seen some of the questions which was asking from this topic: debt or equity. Which one you prefer to finance? There are theories associated with. I will explain those theories. Right now, after some times. Yeah. Debt or equity.
Equity.
Which one you prefer? What is the advantage of debt and what is the advantage of equity?
Low risk.
Hmm? Which is costly?
Debt.
Debt is costly. Why debt is costly? So if for example, take a company, for example, Reliance Industries Limited. So Reliance Industries Limited if they take a debt or a loan from a bank, they can get loan. The interest rate may be 6 or 5%. So that is the cost. Cost of debt, spent by the Reliance Industries is 5%. What is the cost of equity? What is the percentage of return? A return received by the Reliance Industries equity shareholders? You can imagine. So per annually, annual the return in the sense there are formulas to calculate the rate of return. So whatever it is, what the formula use, on an average rate of return, approximately we can calculate like 20 to 25% return is offering by the Reliance Industries shares. Take it as 20. Okay. So in terms of the market price appreciation as well as the dividend, etc. So altogether will be the calculation of return. So the equity shareholders are getting 20% return. That is the cost of equity, and the banks which provide loans to Reliance Industries, and the Reliance Industries has to pay the installment. Interest and principal amount. That cost only 5%. So now, which one is costly?
Equity.
Equity is costly. So that is cheaper. That is a cheaper source of funds, but there is a judicious use of debt. So if we take the debts and we are financing, we are using this debt for debt which is invested in different infrastructure and operation part of the company, etc. But the return from the debts should overrun, should exceed, means return should be in excess of the cost, right? So the cost of the debt is 5%, return is 10%. That is okay. 5% is excess. The company is safe. But sometimes, the project which provide returns are less than the cost. Sometimes if the project, provide only 3%. So the cost of debt is 5%. So the company is, running a loss. Okay. And another point, debt interest is allowed as a tax deduction. So that is, stated by Modigliani-Miller approach. So whatever amount, paid to the bank as interest can be deductible while computing income tax of the company. So the profit-making companies are getting this exemption, and they can treat this as incentive. Okay. So that the debt is cheaper than the equity. Equity is very costly, for a profit-making company. Okay, that is stated here, debt or equity. So, but I said there is a limit for the usage of debt as the traditional theory stated. So you may come across the theories of capital structure. So some theories is that the capital structure which is relevant, and some theories stated that the capital structure which is not relevant, right? So relevant theories, net income approach and Modigliani-Miller, second part of the Modigliani-Miller approach. And the first part, net operating income approach says that which is irrelevant, which shows that there is no such optimum capital structure, and the capital structure, do not influence the value of the company, right? So we will look over that portions lately. And there is business risk and financial risk. So can you explain what is the difference? Business risk and financial risk. Yes.
Systematic risk.
Systematic risk is different. Business risk means, what is business profit? Business operating profit. Do you know operating profit? The EBIT, earning before interest and tax, is treated as operating profit. And there, of course, there is operating cost. So when the EBIT means we are, in excess of the operating cost. After, meeting the operating cost, we get something which is known as the EBIT, earning before interest and tax. After that, we pay the interest to the loans and the tax. So after that, the fund can be available to the equity shareholders, that is EPS. Okay. So business risk means risk that the business will not be able to cover its operating cost. If the company is not able to cover its operating cost, the company is in business risk, because the company is in operating loss. The company is in operating loss, right? The financial risk that the business will not be able to cover its financial cost or financial obligation. The second part. So after EBIT, earning before interest and tax, we get some figures, and after that we have to meet interest and interest against the bank loans, interest against bonds, interest against debentures. So we have to pay all these things, and after that, something which we have to pay tax based on the profit. So you already understood that the interest is a tax exempted item. So after that we have to pay tax, and after that we get something which is known as uh, the earnings after interest and tax, earning after interest, and that can be available to the equity shareholders. Okay. So if the company is, getting a negative figure after meeting these interest and tax, it is known as financial risk. So we have two risks: business risk and financial risk. So now you understand that some companies, even though they are operating profit, but sometimes they are not in financial position is not good, because they couldn't even, their EPS position is weak, because after meeting their interest cost, their outcome, their excess will be less. Okay, they are not sound, right? So business risk and financial risk. I think now you can get an insight regarding the differences between business risk and financial risk, right? So business risk means EBIT, operating profit or operating loss. If we are operating profit, we have some EBIT, because we can get funds after the operating cost, that is EBIT. That is business risk is not there, and we are in operating profit. The next level after EBIT, we have to pay interest on debentures, interest on loans, interest on bonds, etc. So that is a regular payments. So after paying that, we have to pay tax. So interest and tax. Then there will be something remaining that will be available to the equity shareholders. So if we are not able to get a position that is a surplus after meeting these tax and interest, then we are in financial risk, right? Any questions?
Sir, can you repeat once more?
Yeah, sure. So suppose a company, company is functioning, and they are having operating cost, operating expenses, right? What is operating expenses? Gobika SP, where are you from?
Kollam.
Kollam, okay. So what is operating expenses?
Interest.
Yes. Interest is not an operating expense. The operating expense is what?
Good evening, sir. ഞാൻ അന്ന് നമ്മൾ ബന്ധപ്പെടുത്തുന്ന member മലപ്പുറം ജില്ലയിൽ നിന്നുള്ള faculty member അവിടെ pressure cost ഞാൻ കണ്ടു.
Yes, tell. Operating cost means if a company is running, they have to pay salaries, they have to pay electricity charges, they have to run the business, they have to have a lot of expenses, right? That is operating
Okay,
cost.
sir.
That is operating expenses. They have to, meet some working capital expenditures, right? So you studied working capital, right?
Yes, sir.
Yes, there's a short run expenditures, right? So that is operating cost. So if their sales, their revenue, exceeds their operating expenses, known as operating profit. The operating profit, we call it as EBIT, earning before interest and tax. Now you got it.
Yes.
Okay. So if the company is getting a negative figure after meeting the operating expenses, we are call it as operating loss. Okay. So that is not good to the company. These operating loss making companies are known as, they are in business risk. Okay.
Okay, sir. Okay, thank you.
Okay. Then the next concept is financial risk. So financial risk is something which is a top high concept as compared to business risk. So next level, after EBIT, we have got EBIT. That means we are, our sales are high as compared to the cost. So something we have received as EBIT, right? So after EBIT, the next level is we have to pay interest because we have received some EBIT. The next level is we have to pay because, of course, the company, they have obligations. They have taken loans. So they have to pay interest as well as principal amount against the loans, right? And of course, the company is getting a profit in their profit and loss account. They have to pay tax. So after meeting tax and interest, there will be something figure which is positive. It's known as the company's financial position is good. If the company, having a negative figure after meeting the tax and interest, the company is in financial risk. That means from the EBIT, the company is not able to service their debt. Not able to service their debts. Service their debt in terms, in the sense that they have to pay interest as well as principal amount. Right. So that is financial risk. So now you understood the two concepts, which is quite clearly financial risk and business risk. They're all negative figures. If it is positive figures, they are good. There is no risk, right? Got it?
Yes, sir. Yes.
Okay. So now the cost of capital, because I think the topic which is business finance even take 1 month to take the entire lessons. It's very detailed portions. So the cost of capital is very prominent one. The cost of capital of equity, cost of capital of preference, cost of capital of bonds, and cost of capital of retained earnings. So all this you can learn. I think you can study with the help of textbook. I can prefer some textbook. You can use I.M. Pandey. You can use Ravi M. Kishore. You can use Prasanna Chandra for learning this business finance lessons. Okay. So the cost of capital means the rate of return expected by the providers of funds. And there are methods of calculating cost of capital, cost of equity. So cost of equity is a prominent one, and cost of debt, cost of preference, cost of retained earnings, and the cost of bonds. So that is debt. Okay, cost of debt, cost of equity, cost of retained earnings. So at least you should refer these three things. So of course, we now understood that the cost of equity is quite high as compared to cost of debt, right? And the very important portion, that is capital budgeting. So capital budgeting, what is capital budgeting? Just simple concept.
Fixed asset
Yes,
decision.
yes. Tell.
The fixed asset decision related to fixed asset.
Decision related to fixed assets. Can you elaborate? Actually, there are capital budgeting techniques. So suppose a company, going for a purchase of some machinery, that is fixed assets, as you said. So they have to, evaluate the cost benefit analysis, the cost of that asset and the estimated returns, right? So what do they, check, examine while taking that decisions? The benefit should be in excess of the cost, right? The benefit of that machinery should be in excess of the cost, right? The benefit means their estimated returns. So we are expecting some cash inflows. Okay. So the cash inflows should be in excess of cash outflows. So for examining the excess of cash inflows over the cash outflows, we have some techniques. So different techniques, different techniques having different approaches, and their formulas are also different. And some techniques accommodating some variables, some techniques, eliminating some variables. So of course, I would say that net present value is the topmost capital budgeting techniques. Good one. Net present value. How do we calculate the net present value? So you already studied payback method, accounting rate of return method. So that methods are, traditional methods. Payback just covers only the period in which we can able to recoup the original investment. So payback method do not count the inflows after the payback. Some methods are there, the expanded methods are there, post payback method, etc. Discounted payback method, etc. Right. So there are traditional methods and modern methods. In modern methods, we can, methods like NPV, internal rate of return method, profitability index, etc. So all these methods are, taking care of the cash flows, but their formulas are different. NPV, we just, calculate based on the excess of cash inflows minus cash outflows. Profitability index means cash inflows divided by cash outflows. Internal rate of return, the rate of return in which cash inflows is equal to cash outflows. So their calculation is different, but all of the methods intention is remains the same. Whether the companies benefit from the project which is in excess of the cost, right? So hope you understand capital budgeting techniques. Okay, so these are techniques, right? And there is capital rationing. I think this is also important. What is capital rationing? Capital rationing. Suppose you have limited funds only. So you might be aware of ration shops. So in a ration shop, they are giving some, reservation percentage, right? So 2 kg rice, 2 kg wheats. So why they are, sticking on these allocations? because they have limited amount of the facilities available. So similarly, the company's funds are limited. They cannot able to finance the all projects, so they will allocate the funds. This allocation is known as rationing. So based on these capital budgeting techniques, they can rank the proposals. So rank the proposal, rank number 1, rank number 2, rank number 3. So they will, they will select the rank based on rank. They will select rank, proposal 1 or proposal 2, and they can eliminate the other proposals which is not suitable to the company. That is capital rationing. Okay. Any questions? Any questions? No questions. Okay. So opportunity cost of capital is important, significant opportunity cost of capital. You just note down the points, opportunity, and the financial leverage. So financial leverage means the company is gearing. Gearing means the company is in high gear or low gear. High gear means they are using more debt. If they are using less debt, we can call it as low gear. Okay. So degrees of financial leverage. So you just go through this lesson. Operating leverage, like variability of operating return. We just know the operating profit, etc. And the capital structure theories. Of course, the capital structure theory is net income approach. So net income approach is the part of relevant capital structure theories, which means that the capital structure can through the capital structure decisions we can maximize the value of the firm. Okay, so net operating income is an irrelevance approach. They say that there is no optimum capital structure. So their argument is that if the company uses more debt, the equity shareholders will be, their risk perception changes. Suppose I invest a company and I find that the company is getting more debt. So of course, my risk perception, because if a company, using more debt, they have to finance it. They have to pay the debt interest, etc. So there is something risk, and the equity shareholders' risk perception is changing, and they are expecting more rate of return. Okay, so the benefit which is derived from the debt can be offset by the changes in the risk perception of equity shareholders. So that is the logic of net operating income, which is suggested by Durant. And there is a traditional view, of course, the traditional view which combines net income and net operating approach. You start from the net income, and it shows that there is a judicious use of debt, right? There is a judicious use of debt, and after a particular point of time, if the company uses more debt, that is dangerous to the company. That will, that will affect the overall value of the company. And Modigliani and Miller is very important in the examination point of view. Just understand has two type of argument. The first argument, says that there is no optimum capital structure, and the capital structure decisions are irrelevant in the value of the firm. And the second one, that is the relevant approach, changed their version. And in the latest version of argued that there is an optimal capital structure, and said that the debt is the cheaper source of funds. Okay, so you should go through the working capital management like inventory, debtors, cash, etc. And of course, the dividend policy. We have two type of theories: relevant theory, which contains Walter's model and Gordon's model. It's Gordon's, and dividend irrelevance, that is hypothesis. And there is another thing, that is securitization, which is also stated in the syllabus. Securitization means just if a bank, you imagine a bank, and the bank is an institution. They have provided loans. Okay, so the business is accepting deposits and lending money. Of course, they are giving loans, right? So these loans are a very big sum of very big sum, and sometimes some people, they are not regular in paying installments and interest. So what will be the solution to the bank? Suppose the banks are in trouble because the people are not repaying the loans. So there is a solution by the bank. They do sell their mortgages to an agency. Suppose a bank has 10 million loans. They sell the 10 million loans and they just convert the 10 million loans into some assets or bonds. And these bonds are, sell it in the market. So whenever a person purchase, because the banks can sell the bonds because bank has sufficient security with them against that loans, right? So they sell the total loans, or they convert the loans into securities, and it is sell it in the open market, and the people purchase that securities, and banks will get immediate payment. So that is asset securitization. It's a very beautiful concept. Asset securitization is very important in examination point of view. So you can read a financial asset in this context means something that produces payment like mortgage. Imagine a bank loans money, a total X dollars to a bunch of different people to buy houses, meaning that the bank issues mortgages. The people are all expected to make regular monthly payment. The bank can then borrow a little bit more than X dollar because the bank has the loan of 10 million or X dollar, and the bank can convert these loans into securities. Okay, so this is securitization. So this is also very significant. Just cover the entire portions as per the syllabus: asset securitization, working capital, leverage, capital structure, cost of capital, capital budgeting, and other things, GDR, ADR, etc. Okay. So I think I can stop right now. If you have any questions, just ask me. Otherwise, we can make it. So because the thing is very short time, I can just do it like that. I think I did some justification to the contents. Okay, so all the best. You learn it in detail. So you, when you study, you take the textbook of I.M. Pandey, Ravi M. Kishore, and Prasanna Chandra for learning these portions. And of course, you can use the Google. You can use Quora. Okay, so these things are giving good responses of your questions. Okay. Because even though that is that this type of methodologies are not suggesting theoretically, but we can get an immediate response. You go through all these things. Okay, thank you for the opportunity. Okay, I think this will be uploaded in the YouTube, right? Okay. So thank you all. Shall I stop?
Yes, sir. Thank you, sir.
Any
For
questions? Any questions? No question. So you can just ask if you have any questions. You can just mail or through phone. You can ask me. Okay.
Okay, sir.
Okay. Thank you.
Thank you.
Thank you, sir,
Okay,
for
sir.
your spending your valuable time with us. Then this was the last session of our online classes. Hope these classes conducted by the Commerce Club benefited everyone for your exams. Then thank you, Dr. Simon, sir, HOD, Department of Commerce, and Commerce Club for organizing these classes. And good luck for your exams. Thank you, everyone. Thank you for listening. Thank you.